Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. Welcome back to the show, Victor.
Well, thank you, Jim. Good to be back with you.
Victor, you were the lead-off speaker at the World Outlook Financial Conference in Vancouver last weekend. I see your PowerPoint presentation is on your polarfuturesgroup.com website if listeners would like to take a look at it. What were the main points of your presentation?
Jim, the part of the conference that I was speaking at was titled The Coming Commodity Boom. And where I wanted to address that question was sort of what I call a big picture look at things. And one of my first slides was what I call the age of consequences, that we've seen a lot of things happen that are going to have consequences into the future. So I think a lot of the things that I was talking about were extremes. And not just in financial markets, but also in the economy and certainly in the political landscape. I mean, for instance, we've had extreme central bank policies. We have, extreme debt levels any which where you look, We've got extreme underfunded or unfunded liabilities. You look at China, they have had extreme debt over there fueling the growth that they've been on. Another one, say, in more of the political landscape, we've got extreme income inequality. And I think, there's some responsibility from the central banks, or that the central banks need to be responsible for some of this, with what they have done has made the 1%, the hated 1%, that much richer than the people in the street. We have consumer inflation expectations, certainly in the United States anyway, at 30-year lows. Like the man on the street has just no expectation that we're going to see inflation ever again. And then, of course, the obvious ones, we've got stock markets at all-time highs, we've got interest rates near all-time lows, and commodities are really, really cheap relative to stocks and bonds. So I'm kind of one of those guys that's a mean reversion guy, or the pendulum swings one way and it swings back the other way, that sort of thing. So at some point, I think, commodities will be a buy, and I did list off sort of like the ideal environment that we would need to see, or let's say if you were a commodity bull and you had an idea about, what would be an ideal world environment for commodities. I mean, it would include aggressive government deficit spending. Let's say, and the new thing is, on all the green programs. It would include accommodative central banks, a weak U.S. dollar, rising wages, consumer inflation, and for sure, Chinese buying. That would be key. So that was, I guess, the intention of my presentation was not so much to say, hey, rush out and buy commodities right now, the boom is starting. It was more like, let's take a top-down view, a big picture view, and say, here's the things to be thinking about so that you can be prepared as we get close to the time when the commodity boom is underway. And, for instance, another thing I mentioned there was what I see happening in ESG and how that will impact markets as well. And let's say, I guess the last thing, just to finish off the talk, I discussed some of the trading rules that I use that I think people could incorporate in their own trading or investing when they get active in the commodity markets.
What was the mood like at the World Outlook Financial Conference?
Well, we had about 1,500 people at the Bayshore Hotel in Vancouver, and I think I think people were really listening closely to what the speakers had to say. I know on the Saturday I was doing my Master of Ceremonies chores, and I said to folks, listen and see if you don't hear some common theme amongst the different speakers. I mean, we didn't all sit together in a room and, compare notes before we came here. It's just you've got 10 people here from all over the continent in different aspects of the market that are watching markets, and see if you can hear some common themes. And true enough, I had a number of people come up to me at the conference and say, the common theme I'm hearing is that like virtually everybody is talking about big changes coming that are going to, say, rattle our world, as we know it now.
You said at the conference you think ESG will have a bigger and bigger impact on the markets. What is ESG, and why would you say that?
ESG is environment, social, and governance. Let's say, the environment aspect, I think we're probably all very aware of, where people have some kind of environmental responsibility, and certainly, the government levels and regulatory environments, that sort of thing, that, nobody likes pollution. Okay, let's go to that. But I think the other two aspects, the social responsibility and the governance thing, are maybe a bit hidden from view, as it were, or just people just don't see those as being anywhere near as important as that environmental aspect. I think this ESG movement, which it seems to me is one of the hottest things on Wall Street these days, particularly at the institutional level, that is with pension funds, endowments, that sort of thing, where people are very sensitive, I think, to being, call it, politically correct. I mean, let me give you a for instance here. You can just imagine, the folks that are embracing ESG really do not like what they call dirty oil. Okay, and they point their fingers at the tar sands in Alberta. If there is, and believe me, there is already, but it's going to, I think, snowball and get bigger. If there is disinvestment, in other words, the ESG folks that are, in charge of things, that particularly at the institutional level, decide that they don't want to buy shares in companies that are involved in exploring for oil or developing oil or transporting oil or having anything to do with, particularly dirty oil, we could see something happen in the future where if the oil industry is starved for capital, they don't have the money to go out and do CapEx, to explore for oil, to develop properties and that sort of thing, and therefore we start to run short of oil on the supply side. You could see, I could picture this, where the price of oil jumps, okay, as a supply-demand issue, but the shares of the companies that are in the oil business don't jump right along with crude oil, because you've got this wave of disinvestment coming from the folks that are subscribing to these ESG principles. On social responsibility, previously, and I don't know if this is the good old days or like what it used to be, whatever, things change. Previously, companies were largely trying to maximize shareholder value, okay, while working within the laws and so on and so on. Now these companies are going to need to think when they're making corporate decisions, how's that going to look to the politically correct crowd? Are we being socially responsible? Have we got people on our staff that are, there to keep an eye on us, and we're reporting in such and such a way that and there aren't, as far as I know, specific rules about this, but it's going to change at some level what people are doing, or the decisions they're making to do or not to do. On the governance side, let's say, it becomes increasingly in the media that you haven't got enough women or minorities or whatever on your board of directors, and you need to have more of that. And if you don't, then the institutional money is going to sell your shares. Okay, you can't enroll these people in funding some of the projects that you want to do. And let's maybe get a little extreme, but let's say it's a bank somewhere, and you have an executive from an oil company who's on your board of directors. That wouldn't be unusual. Well, the ESG folks may say to you, listen, that guy's got to go, because so long as he's on your board of directors, you're going to make bad decisions because, he's in the oil business and therefore he's not a good person. I mean, I'm exaggerating, perhaps, but I'm just saying that this ESG thing, this new way of looking at markets, is going to have an impact. I think it's also generational. I think the millennials are going to embrace the ESG principles and the application of those principles much more than the baby boomers. And let me just wrap it up this way. Just kind of, it's all part of the same thing. Let's say that, we remember Dwight Eisenhower. One of the big things that he did during his presidency was to get started on building the interstate system throughout all of the states, the freeways, and the thought there was to expedite business, to make the economy grow, and so on, to employ people to build these things and like that. So let's say the government of the day was very much more business-oriented, whereas today it seems as though the government are more populated by people that are social workers. So ESG, if you like it or you don't like it, doesn't matter. I'm just saying I think this is going to have a much bigger impact on the markets going forward than we've seen in the past.
We'll have more with Victor Adair right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Victor Adair. Victor, when we talked about a month ago, the coronavirus was virtually unheard of. Since then, of course, it's the major news around the planet. We've seen copper and oil prices drop, but the major stock indices are trading at all-time highs. How can that be if the virus is so bad and yet the markets are doing so good? What are your thoughts?
Well, it's been complicated, certainly, but let's start with this. I think the virus has highlighted, if we needed any more highlighting, the interconnectedness that we have in the world today, and the vulnerabilities that come from that interconnectedness. And then there's the other thing about, you wonder, well, what's news? What's fake news? Who do you trust on this? Who's got an agenda to lie? And so on, so there's all that. Maybe we just leave that aside and not try to analyze it. We've seen copper. I think it dropped for 13 consecutive days. Never happened before. Dropped about 14% in just over 2 weeks. And crude oil, you mentioned that. Now, crude had spiked near the beginning of the month up above $65 as tensions, that's the polite word, between the United States and Iran were underway. And then as those tensions seemed to diminish or at least back off as both sides seemed to step back from, escalating a confrontation. So we had that WTI price up above $65, and the lows here the past few days has been with a $49 a handle. So that's a 25% decline. And again, prices were maybe a little higher than they would have been otherwise at the beginning of the month because of the confrontation between Iran and the United States. But in the case of both copper and crude, the critical reason for why prices came off was very much about worries about or concerns about Chinese demand for those commodities would be reduced. It's so interesting on the stock side that, stocks sort of like the WTI had been trading at new all-time highs. As a matter of fact, the stock market had been rallying from, certainly last October lows, even if you go back to the August lows. The overall stock market had been in this very strong, steady rally, and sort of a Goldilocks environment with stocks. I mean, on the one hand, in the summer of last year, there was worries that a recession was maybe just around the corner. Interest rates were the lowest they'd been ever. The amount of negative yielding bonds out there, another representation of the interest rate environment, over 17 trillion. Never been that much before. And it's just, the yield curve was inverted as well. So there was that thinking last summer that this recession was looming. And as we kind of went through the fall, it was sort of like, well, maybe not, and maybe we got the reflation idea was creeping in. So here it was, perhaps the 3 interest rate cuts that the Fed had done throughout the year, or throughout the previous months, were starting to kick in maybe, and the economy was doing better. Certainly, the unemployment rate wasn't ticking up. That was as strong as it had been in 50 years. So, and there's lots of liquidity in the system, and then there's just momentum. Every day it goes up. Anytime it dips down, that's a golden buying opportunity. So stocks really weren't much impacted by this news around the virus. I mean, nowhere near to the degree that the commodities were. We had a couple of nervous moments, I think particularly a couple of Fridays, I remember, where the market was really selling off, the stock market really selling off going into the weekend. And that's just like, if you don't really need to be long over the weekend, why not just, sell out now, stand aside, and if we got some really bad news over the weekend where you can't take any action, you're going to be stuck, and then come Monday morning, there hadn't been any bad news, and the market's got bid again. And when I say bid again, we're making new all-time highs here again this week. The NASDAQ 100, which seems to be leading the parade to higher and higher prices, it is trading more than 20% above its 200-day moving average. So the stocks seem to be, richer than you might think they should be, but, here's where they are, and the market just seems to not have any worries.
Victor, I'm glad you brought that up because I was going to ask, because we're seeing a definite pattern. The stock markets go up during the week, then the board turns totally red with pretty big numbers on Friday. And you explained why. People just don't want to have their money stuck if something bad happens. Yeah,
absolutely. The most important price of the week, as far as I'm concerned, is always the Friday close. Because and that was more important in the old days when we were actually closed on Saturday and Sunday and didn't open until Monday morning. These days with the markets I trade, we actually start trading Sunday afternoon. But it was, this is the price that you're willing to live with through the next couple of days when you can't trade. So that's why Friday was always such an important price.
We'll have more with Victor Adair right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, how have the currency markets reacted to the coronavirus?
Well, let me do it this way. Last fall, as we were headed into the end of the year, I know when I was talking with you, I was dithering a bit. I'd been pretty resolutely bullish the U.S. dollar for some time, in some regards, going back to 2011, when I think we made the real turn. But certainly over the past several years, I've been generally U.S. dollar bullish, and sometimes more than more than a little bullish. But near the end of last year, was less bullish. I guess at the very end of December, the U.S. dollar index, which a lot of people follow, was trading at about a 5 or 6 month low. Now, in the currency markets, the thinnest volume of the year is the last 2 weeks of the year. So everybody squares up their books and gets ready for the next year. But all the same, the U.S. dollar was trading down against virtually all of the currencies. And then right at the year end, right at the year end, the markets reversed. And since then, the U.S. dollar has been rallying against all of the currency markets, and it's been up especially against emerging market currencies. I think here's another barometer I look at, is the relationship between the euro currency and the Swiss franc. In the past month or so here, that spread has gone out to a 3-year low. In other words, the euro is a 3-year low against the Swiss. And to me, that's a nice barometer of let's say, worry in the market. When people in Europe, in particular, are concerned about things, they like to buy the Swiss franc, or they'll sell the euro, buy the Swiss franc. So you see that spread move. And I think that worry that shows up in the euro-Swiss spread may have also showed up in the U.S. dollar being strong, as I say, particularly strong against emerging market currencies. I've said on this show many times that capital comes to America for safety and opportunity. Or you could say it leaves the riskier parts of the world and kind of comes back to the safety of the United States. Another currency I think that was very illustrative here of the mood, Australian dollar had hit some recent highs right at the end of the year as the U.S. dollar was weak. But again, right on the year end, it pivoted, and through the month of January and into early February here, the Australian dollar down about 4%. Certainly part of that was related to, Australian exports into China. If China's not buying stuff from Aussie, then the Australian dollar is weak. So in a nutshell, the currency markets have reacted with a stronger U.S. dollar, and with the U.S. dollar particularly strong against emerging market currencies, and the Australian dollar often trades like a surrogate for the emerging market FX.
Historically, the U.S. dollar is strong and gold tends to be weak, yet gold's actually been steady to higher year to date, while the U.S. dollar's also been strong. What do you think's going on there?
Yeah, that's exactly right. Historically, if you want to go back over, say, the sweep of the last 20 years, gold and the U.S. dollar have an inverse relationship. So if the U.S. dollar is generally strong, then, you expect that gold's going to be weak. Certainly there are other things that are in that equation, in the relationship between gold and the U.S. dollar. And I think in the last, let's say the last year, I think that actually that interest rates have had a bigger impact on the gold price than the U.S. dollar has had. And we've had negative interest rates. This is negative real rates, I should say, after you take the nominal rate and subtract out inflation. And I think you go back to certainly late 2018 is when the gold rally kind of started. And then we got a kick higher last summer, let's say at the end of May, beginning of June. And going through the summer was when interest rates in the United States were like other parts of the world, but in the United States in particular, interest rates were falling. We got to the end of August when the long-term interest rates in the United States were at their lowest ever level. And that stack of negative yielding interest rates around the world got north of $17 trillion. I think that had a very big impact on gold, and it just at a practical level, Jim, so folks could understand. Over the years, one of the arguments against owning gold is that it doesn't pay interest. You could just have your money in a bank account and you could do nothing with it, but you could get paid for having that money. Whereas if you bought a brick of gold, it just sat there. You got nothing. So then, if there is no alternative like putting your money in the bank and getting some interest, then suddenly, gold's not like a lead weight, you're not giving up anything to buy gold. So that would be one of the reasons why negative interest rates, I think, spurred the price of gold. Was the thing, there's less barrier to want to switch into gold. When the U.S.-Iran problems developed, the tension, the beginning of January, we had a spike higher in the gold price. Now, I said there's a number of things that impact the gold price. There's the U.S. dollar, there's relative interest rates, and then from time to time, there are these geopolitical crises, which you obviously can't predict, but they'll have an impact on the gold price. Now, why that was important is because we traded the gold market up above $1,600 an ounce, kind of in a spike, and that came quickly right back down again. I'm calling that a pivot point. So the price that we got then, let's call it $1,605 or whatever it was, will technically act as a lid on the gold price. And let me say it this way. If that's the best gold could do when people were scared to death that maybe World War III was going to start, what needs to happen to get the price to go higher than that? Well, then, let me answer that question with my own this way. If the price does go higher than that, then there's something pretty bullish that's moving the gold. So a pivot point. It should be a lid, that 1605 or so area, but if the gold trades up through that level, then you better be a buyer of gold.
For the past 8 months, the Canadian dollar's been trading around 75, 77 cents. Why has it been so quiet, and when do you think it's going to break out? And if it does break out, what direction?
Yeah, Canadian dollar has been extraordinarily dull. It seems like it was longer than that, but you're right. It was just since the summer of last year. But even going back a year and a half, it's been in a 3-cent range. Well, the Bank of Canada has set on their hands. They haven't done anything in terms of raising or lowering interest rates in the last year, while the United States, the Fed, has cut rates a quarter point 3 times. So Canada wasn't doing anything. It just seemed, and it's not just Canada, actually, by the way. The volatility measures that we use in the foreign exchange options market here in January even we're at the lowest ever level. I mean, it's just like there was no volatility to speak of in the currency market. So it wasn't just Canada. It seemed like the whole board. Gosh, I mean, I'm a little stuck on, what to do with Canada. I think it's obviously, so is everybody else. For years, I have had a bearish bias on Canada, and I've had some of my savings in U.S. dollars as opposed to Canadian dollars, and had those positions for years. Here's another way of looking at it, though. I mean, certainly, so far this year, Canada has been weaker against the U.S. dollar. It's dropped about 2 cents. And just like the Australian dollar, by the way, at the end of last year, as the U.S. dollar was weakening, Canada traded to, I'm going to say, maybe a year high, but those thin conditions at the end of the year were in place. And then as soon as this new year started, Canada fell against the U.S. dollar. But Canada is up against the euro currency. Canada is up against the Australian dollar. So, we always see Canada against the U.S., but, it's kind of been just in the middle of the pack. And, honestly, I have no idea at this point, why or why it would break out or which way it would go. So I'll just watch it and see what happens.
Late last year, you frequently commented on your Polar Futures Group blog and also on this show about the key turn date around the beginning of September when U.S. long-term interest rates hit an all-time low. You were wondering if that would turn out to be the low for interest rates, because if interest rates are rising, what kind of an impact would that have on all the markets? Well, what are your views now on interest rates?
Yeah, I was fascinated with what I call the key turn date that happened right around the beginning of September last year. And the actual real key was the all-time low for the U.S. long bond in terms of interest rates. But the thing that made it that much more significant was there was a whole bunch of markets whether it was copper, or wheat, or sugar, or cattle, or just a whole bunch of markets that made a change in the trend that they'd been in, and reversed the trend on or around that same date. So I thought, hey, something big happened here, and the best I could see was it was this possible end of the 40-year bull market that we've had in bonds, where interest rates have fallen and fallen and fallen, while bond prices have gone higher and higher and higher. We've had roughly 2 generations of people in this country, this continent, that have known nothing but interest rates continuing to fall. In the real world, where consumers go and buy something, they're not so much focused on what's the price of the thing. It's like, what's it going to cost me every month to own that? So, and that cost is very much a function of what interest rates are. So if interest rates were to start rising, in other words, if that was the low in interest rates back on the 3rd of September, that would have an impact all across markets. Well, as we went through the fall, interest rates were rising. As I mentioned earlier, the thinking through the fall was, hey, we're not going to have this recession. We've got a bit of a reflation trade going. Things seem to be picking up. And then we got to the end of the year. And again, I say something big happened in the U.S. dollar at the end of the year. Something not quite as dramatic happened in the bond market. And that is that bond prices started to rally again. Now, they're nowhere really near where they were back in September, but interest rates have been falling. Bond prices have been rallying since the beginning of the year. And I think there is some credence out there to the thought that, hey, that recession that we thought might be coming, I mean, after all, the United States has been in the longest ever economic expansion without a recession. So, hey, maybe that recession's coming after all. I mean, we got some miserable economic stats out of Europe this morning. Certainly China is in a slowdown mood. And this was, like the slowdown around the virus seems to be like the cherry on top. Things were already slowing. So maybe, we have interest rates are not going to be going higher. And when I say interest rates, I saw something here today where Greece, who was in so much trouble here a few years ago, the interest rates on their bonds now are below 1%. This is, the United States has to pay about 1.6% to borrow money for 10 years. The Greece can get money for less than 1%. And throughout a big part of Europe, interest rates remain weak. I think maybe the key question, Jim, to wrap up here on that is, with these really weak economic stats we're seeing in Europe, what is the ECB under their new head, Lagarde, going to do? Are they going to try to renew the experience of pushing interest rates deeper and deeper into negative territory? Or, and this would be where I think we're headed, they're going to lean on the governments and say, particularly Germany, you need to start spending. You need to do fiscal stimulus. And maybe they can dress it up in terms of kind of environmentally friendly things just to get the foot out the door. But I think we're going to see that, and I think as we see governments stepping in to help out the central banks who maybe, run out of bullets, and the governments step in to do fiscal stimulus, that may be when we start to see interest rates rise.
You might recall 10 years ago when the worldwide recession hit, Germany's solution was to give people $10,000 if they bought a new car. Would that kind of thing work again?
Yeah, well, let's say fiscal stimulus. I mean, it's Ben Bernanke used the term helicopter money in his famous speech a number of years ago. Like, if things get bad enough, we can drop money from helicopters to stimulate the economy. That is still monetary policy. Fiscal policy, maybe back in the Depression era, they would have make work projects. Let's go build a dam somewhere. Let's string power lines, electrify, parts of the rural parts of the country. People talk about modern monetary theory. I think we're probably headed down that road. And I guess while we're on that path, I mean, you just say there's so much debt outstanding. One of the arguments against interest rates rising is that there's so much debt outstanding that if rates start to rise, then the rise in the service cost, people having to pay interest on that debt, would kill any recovery. So, it's a bit of a conundrum. I mean, I can certainly see in some respects you get the bigger picture where they just have what's called a debt jubilee. They just cancel the debt, or they put it on the balance sheet of the central bank, or in effect, like normal people, you just say we're in such horrible shape here. The only solution is we go into bankruptcy, wipe the slate clean, and start over. So, I think that's part of we're gonna see some really big, crazy moves, crazy relative to what we understand these days in our future.
When we started this interview, you said you'd talked about 6 key trading rules at your World Outlook presentation. Well, what are some of those rules?
Well, not to go on too long, but I'd say maybe, the first one that I said to the folks in the room was, you need to be aware of what I call the news, but trade the price action. As I get older, and I've been doing this for 50 years, trading these markets, I am more and more convinced that I really don't know very much. Put it this way: there are people trading in the same markets that I trade. I have no idea who they are. I have no idea what is motivating them. I certainly have no idea what size they can bring to the market or what their time horizon is. But when I keep an eye on the charts and I follow the price action, as I call it, those folks are going to leave footprints on the charts. And, sometimes you have something happens and you say, oh, great, that's going to be bullish news for the market. And you look and prices are down. You go, what? What's that all about? So you've heard the whole saying about, buy the rumor, sell the news. Well, it's that sort of thing. There's folks out there that have got information you can't possibly expect to have. In fact, you wouldn't even know it if they gave it to you. You wouldn't be able to make any sense out of it. There's these other people that are in the markets, and I cannot keep up with what's going on and make sense out of everything, but I can make money when I pay attention to the price action. So I think that's very important to do that. And just maybe one other rule, and I call it to find a way to trade, find a way to invest that suits you. Different strokes for different folks, that sort of thing. And it's going to take you a while to figure that out. You're not going to be able to read somebody's book. Follow my 10 rules and you will become a zillionaire trading in the markets. You can't wear somebody else's boots. You kind of have to find your own way. And over my career, when I've met guys that had real success in the markets, I tell you, they were as different as chalk and cheese from each other. Everybody that had done really well had his own way, and it didn't really have anything to do with what other guys who had done very well were doing. So it's going to take some time, but you've got to find your own way to participate, and will be able to be successful.
Victor, thank you so much for being on the show.
Well, Jim, it's always a pleasure to talk with you. Thank you.
My guest has been Victor Adair, co-founder of the Polar Futures Group. His website, polarfuturesgroup.com. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.